Hello, everyone. Greg Sykora here. Mark is up at his cottage. Today, I thought it would be timely to address topics that have come up more than once over the month of July in our conversation or during my reviews with clients like you, which include one, is the market about to correct, and when will all these market returns either start to reverse? Should we be taking less risk? And two, the long-term secular trends that are driving this market forward, aka returns. And finally, housing prices. Where do the value of homes currently stand, and how far have we dropped since 2022? Well, let's get started. So I thought I'd start off with a table I found on LinkedIn from an economist about a week ago. It shows the number and average length of recessions across different 20-year periods from about 1857 to 2026 in the United States, discounting technical recessions. A technical recession is when you have two back-to-back negative quarters followed by growth. Last quarter, Canada was actually we just entered a technical recession, but it doesn't look like we're in a recession anymore. Anyway, as you can see here, in the late 1800s and early 1900s, recessions were more frequent, with up to 6 occurring in a 20-year span, and they often lasted 19 to 29 months. Over time, both the frequency and the duration of recessions generally declined. The most recent period, from 2017 until about now, we've only had one recession lasting about 2 months. And that's highlighting a longer term trend towards fewer and shorter economic downturns. So why is this happening? Well, there's three key underlying factors. One, we've got stronger companies with more financial transparency than ever before, meaning markets are increasingly efficient and less prone to bubbles. Basically, markets are able to sniff these recessions and bubbles out before they actually happen and turn into major blowups, meaning we only experience short, small declines. Two, central banks across North America, Europe, and developed Asia pump up the economy, and they've been preventing massive market meltdowns. We basically use taxpayer dollars in many cases to ensure the stock market stays high. And three, we've got more people investing than ever before, and this continues to drive markets higher. So let's talk about that for a second. As I just mentioned, it's never been easier than ever before to use an app to invest. Stock market participation in North America is at the highest level it's ever been, primarily coming from the proliferation of self-directed, do-it-yourself investing. It's often forgotten about, but the reality is that technology has made it easier than ever before for someone to invest on their own. And retail investors, aka you and me, we now make up, not always, but more often than not, more transaction volume on a daily basis than smart money, aka institutional money like hedge funds. Further to that, you may have heard of Trump accounts. What's a Trump account? Well, it's a $1,000 seeded investment account for children born between 2025 and 2029. I've read that already. I think there's about 7 million Americans that have opened up Trump accounts for their children. I mean, why not? It's free money. Basically, the account allows for a one-time $1,000 government-funded deposit, and it's restricted, should I say, to only investing and being able to use low-cost index funds, exactly like your portfolio and what you're currently invested in, which is a good thing. Despite how most of us feel about Trump, and not to mention the vanity associated with labeling these accounts as Trump accounts, considering these are funded from taxpayer dollars, even though I despise this guy, I think it's actually a pretty cool idea. And by the time most of these kids go to school at 18, this $1,000 will likely to have grown for somewhere between $5,000 to $10,000 if it's invested aggressively, depending on how it grows and the growth rate. the Trump admin put out some crazy graph showing, what this $1,000 could grow to on Truth Social. And if this $1,000 stays invested and follows the historic returns of the S&P 500, you can have $1,000 turn into 150K by the time this individual, this newborn, is 65 years old. So if everybody's getting access to the market and hopping on the market train, what will put a stop to this charging bull? In my opinion, one of the biggest risks is we have a medium decline that's drawn out, that blows up into a much larger one. How will all of this new money react the next time we experience this major downturn of, say, 35% or more, when all these people know is markets going up and they're likely taking on too much risk, or worse, they don't understand the level of risk they're currently in? I guess it's to be determined, but in my experience, many of the younger do-it-yourself investors who have yet to go through any sort of crisis, they don't have any real experience or any of this sort of stuff, a lot of them are doing their own financial planning on these DIY platforms, these robo platforms, and they're baking in crazy return assumptions of like 10%. I don't count COVID really because it was like a flash in the pan. It took about 2 to 3 months for markets to recover. But if there's a run for the exits and the whole is, say, a 35 to 40%, and it's not short-lived because, central banks are taking a look at this. They're looking to backstop the economy through easing, and then you get governments through fiscal spending. If they can't plug this hole and we have a prolonged downturn, my guess is it could get ugly. I don't know how ugly because it's TBD, but we'll see. It does worry me, but for now, corporate profits, they've never been better. We've got double-digit corporate profits. The bull looks like it has legs. Technology and AI, it's deflationary. So of course, we've got tariffs and all these things that are adding inflationary pressure, like increased energy prices. But then you've got deflation on the other side from companies adopting AI technologies. So there, in my opinion, there's no real reason to be taking on less risk. The lack of recession shouldn't dictate portfolio risk. Portfolio risk should be based off of your financial planning goals. And finally, Canadian home prices just hit their largest real estate correction, or we've just hit our largest real estate correction on record. But the number that matters most for planning for someone like me isn't the headline, it's the difference between the nominal and the real inflation adjusted returns. Nominally, prices are down since 2022 about 20%, but if we adjust for inflation, they're down closer to 30%, or some reports reads back to around 2016 levels. Keep in mind, real estate is highly localized. Some areas are down significantly more than others, such as Oshawa, Whitby, they're down closer to around 40-45%. Hamilton's down closer to around 35-40%. Now, if I were a betting man and I had to guess where I think real estate goes from here, and if you are thinking about doing anything in real estate, such as moving up the ladder, I think we're probably at or near the bottom, because it looks like a lot of the policies and a lot of the groundwork that our government is currently doing, despite shifts in immigration and the like, it looks like we're setting up for increases in trade and some robust growth, which are going to likely drive housing prices higher. So that would be my guess. And that's it. I appreciate you tuning in and listening to the July update. Hope you're having a great summer, and I look forward to giving you the August update in early September. Thank you, everyone.